Let's get going. Welcome everybody to this webinar on funding. Always a critical topic for SMEs of all shapes and sizes. We all need funding and more of it as we go along. And it's been a particularly challenging period, hasn't it, with the prolonged impact of COVID on businesses in terms of demand and supply, and also in terms of the funding climate as well. So morning from LawBite. So my name is Clive Rich. I'm the CEO and founder of LawBite. My background as a barrister, worked extensively in-house for many years at larger companies like Bertelsmann and Warner and Sony, and then had a sort of epiphany and realised that law firms are really all looking up the value chain to large companies, and SMEs, who represented over 99% of companies, just didn't really get a look in. And so came up with the idea of a technology platform that would serve all SMEs and hopefully give them law the way they want it. And we've now addressed over 40,000 SME inquiries at LawBite, so hopefully in the right place at the right time. Thanks, Angie. So what we do is operate a marketplace between SMEs and expert lawyers, covering everything from startup to exit for SMEs, and we run that marketplace through our own proprietary technology platform, which provides a complete workflow and communication experience for the SMEs and the lawyers, and helps match the right lawyer to the right client. The aim is to create a service that is fast, affordable, and easy to use, rather than slow, expensive and complicated, which is what a lot of SMEs might have been used to in the past. And we don't sacrifice any quality in doing that. We have our own regulated law firm bolted into the platform, which is called LawBriefs, with some 60 lawyers on it, covering everything that SMEs need. And LawBriefs is an SRA regulated law firm, so you're getting quality law from experienced professionals, on average 15 years post-qualified experience, but getting it quicker and at a fraction of the normal price. So SMEs are great ones for putting things off when it comes to commercial legal matters. Always other things to do, aren't there? Marketing to do, R&D to do, funding to raise. All our research, though, indicates that SMEs get themselves in trouble with that approach. So when they leave it till the point at which their hair's on fire before they reach out to someone, it's often too late to mitigate the damage. And we calculate SMEs lose almost 14 billion a year by failing to take care of their legal issues. That's from a recent YouGov survey. The same survey identified which of the things that come up. Actually, it's a very broad range, but disputes, issues with employees or contractors, contractual issues either with customers and suppliers or in terms of terms and conditions, software and tech. These tend to be the main baskets of issue that we see day in, day out, and it hasn't changed much even during the height of COVID. So do send us your questions as we're going through the webinar, and we've left space at the end, and we'll endeavour to cover those questions off with our expert speakers. If we can't do that, we run out of time today, we'll come back to you directly. And we're delighted to have two funding experts with us here today. First of all, our very own Andrew Smith, who's a LawBrief with us, and Andrew has a considerable experience in banking and finance, corporate and commercial law. Originally a car-carrying Aussie, but we count him as a qualified English now. Spent a lot of time working at Adlersholt Goddard, major law firm in London, on debt and banks and property finance deals, and since 2012 has been operating more as a freelance lawyer, and we're delighted that for most of his time as a freelance lawyer he's been with us, and fantastic lawyer he's been too, very experienced and knowledgeable, and great fun to spend time with as well. And very, very delighted to welcome Stacey Clementson, who's Fleximize's head of credit. So Stacey's head of credit and underwriting at Fleximize and has plentiful experience in operations management and credit risk for both consumer and business lending, and likes to create fast, friction-free routes to securing finance for small businesses. Amen to that, say all of us. Stacey, do you want to say something about Fleximize? Maybe it's your slide.
Yeah, sure. Thank you very much, Clive. So I suppose at Fleximize, we've since 2014 been looking to sort of help the SME market in places where banks essentially sort of stopped helping, particularly after the 2009 crash. So since 2014, we've spent over 150 million to over 3,000 SMEs. We've won quite a few awards for our service that we've been providing, and we all offer a lot of flexibility in our loans, just as a standard part of our documentation, really, because obviously we understand that, particularly in the SME market, you know, things happen, cash flows can be up and down, so we really wanted to tailor our products to the SME market, and a lot of those features were particularly useful over the pandemic and throughout COVID. And essentially, we offer a lot of different support for SMEs as well via our Knowledge Hub and other resources on our site. So it's not just sort of about funding. You can sort of gain support for various different things through our member marketplace and our Knowledge Hub as well.
Great, thank you very much. Welcome to both of you. So we've got an action-packed agenda, and during the course of today, we're going to look at debt funding as an overview, and with some specific debt funding options, working capital loans, some of the legal aspects of debt, and also the other side of the funding equation, equity funding, different types of equity or quasi-equity, if you've got it here, and advanced stages of equity funding. So hopefully something there for everybody. Thanks, Angie. And I'm going to hand over, I think, to Stacey first of all, to talk through the debt funding.
Thank you, Clive. So I'm going to talk a little bit about the pros and cons of debt funding and different types of debt funding that are available in the market at the moment. So typically you'll find that debt funding comes in the form of a traditional loan paid back at an agreed rate, usually with fixed monthly payments, although interest rates can be fixed or floating. So I suppose similar to what your mortgage might be. If you fix your mortgage, your monthly payments will stay the same. If you don't fix your mortgage, they might be a little bit volatile depending on interest rates at the moment. Obviously very low at the moment, so probably not the worst thing in the world if that is the case. So there are so many different forms of debt funding, and they're all, I suppose, aimed at different types of businesses. So you might find that even though one option isn't for you, there might be other options available in the market that are actually perfect for you. So good things about debt funding is that you do get to keep control of your business. So you're not giving away any shares. It's a very simple sort of lend money, pay it back transaction. It can offer quite a quick solution to short-term cash flow issue, or even potentially sort of slightly longer-term cash flow issues, depending on what options you choose. You should have the flexibility to grow with the debt funding option, obviously being able to go to different various options that are available as well. I mean, you can get sort of debt funding available in the market for sort of same-day funding now, so it's a very quick fix for those type of issues. And once you've repaid your loan, you're no longer liable, obviously, for the loan, which, unlike other types of funding, you might find that you still have some liabilities left to them. In terms of cons, it is generally a higher cost of finance than equity, because obviously they're not investing in the business for a long period of time. The cost comes at the interest rate ultimately. Repayments will have to be made out of your cash flow, so obviously you'll need to make sure that you can consistently afford to repay that debt to avoid any sort of enforcement issues. And a lot of the debt funding options will now require a personal guarantee, which obviously, unlike a lot of other, unlike equity funding, you would be liable if the business fails. So I suppose you sort of lose that protection of being a limited company, because your personal guarantee will make you personally liable in that case as well. So just going to move on to different types of funding that are available in the marketplace. Working capital finance is generally your typical loan. So Fleximize offers working capital finance. So it's that simple transaction where, you know, you're lent a portion of money and then you repay it back at over an agreed term of an agreed interest rate, and usually a fixed monthly payment. There are some other types of a fairly new type of working capital finance. The merchant cash advance sort of come in, I suppose, definitely in the last 10 years anyway. So this is slightly different than your traditional loan. You'd get the loan in the same way. So you'd borrow, say, £50,000, and there's an agreed total repayment of that £50,000. So you might agree to repay the lender £60,000, but there's no fixed term to that. How that's repaid is it becomes a percentage of your card payments, either on a daily, weekly or monthly basis, depending on the lender. So that could take 6 months to repay, it could take 12 months to repay. It's ultimately down to how your business performs during that time. Obviously, if the business performs very well, it will get paid very quickly. If you're having a few slow months, then it will take longer to repay back. So although it's not as sort of predictable as a loan, some businesses find it useful because the payments vary in line with their cash flow. Whereas other businesses like the predictability of a typical working capital loan. And then there are sort of more specialist finance. So invoice finance, people tend to use if they have business-to-business sales, and essentially a company will lend against each invoice. There are a few limitations to invoice financing. So although you can get those invoices paid, some businesses may not be able to fund invoices from all of the businesses that you deal with on a day-to-day basis. Obviously, a lot of sort of servicing fees and different rates and LTVs available on invoice financing as well. Asset finance, if you've got a sort of heavily, I suppose, asset-backed business, so I'm thinking things like construction, waste disposal, those kind of businesses will tend to have a lot of machinery, and you can often raise capital from that machinery, and because you've got assets behind it, it can be at a cheaper rate than your standard sort of unsecured loan or merchant cash advance. Property finance, I won't go into too much detail on, but typically it works in a similar way to how your mortgage company would work, or if you took out a secured loan against your house, but primarily on commercial property. But what you'll tend to find with property finance is that LTVs, sort of maximum amounts that you can borrow, are lower than what you would find with your typical mortgage provider on a personal property. And obviously rates will be a little bit higher than what you're probably used to in terms of dealing with a residential mortgage as well. And then trade finance can help fund sort of large stock purchases, particularly overseas. And they're ongoing facilities, but tend to be used for sort of one-off purchases, and then you can re-borrow, so almost like a revolving kind of facility for ongoing trade. So I'm going to bring it back to working capital loans because I suppose they're sort of more wider ranging. There's no sort of, I suppose, particular businesses that these tend to be aimed at. So these can be available in the market really quickly. A lot of sort of newer lenders to the market, I suppose, are offering loans within 24 hours. And even banks are not sort of particularly slow at providing them these days. They typically come with secured and unsecured options. The security side of things could be various different things. It could be from assets within the business secured by debentures, it could be commercial property, it could be your residential property. So these are all options that are available as working capital loans. It's just sort of which one you want to opt for. Unsecured loans are typically backed by a personal guarantee. There aren't too many lenders in the market that will do completely unsecured loans, and if they do, it's usually for much smaller amounts. So there's quite a few routes to go down, and I suppose what the assessment is what's best for your business. How can you raise the amount of money you need at you know, the cheapest or the most flexible rate for your business. So it's very much finding the type of finance and a lender that works for you. Each lender through every different type of finance will have different eligibility criteria. They could be anything from whereabouts your business is based, if you're a sole trader or partnership, to a limited company, turnover, length of trade. They might have affordability criteria that include things like debt service cover, but what you will find is that they vary massively between lenders. So if you're not finding success with one particular type of finance or one particular lender, you might find that success elsewhere. So don't be sort of afraid to speak to different lenders and ask them about their criteria and what they need, because although one might not be able to help you, others typically can. And I mean, we would sort of try and point people in the right direction if we feel like they're looking for a type of finance that we're not able to offer, because we know that there are perfectly sort of good lenders out there that can help these types of businesses, even if they're not for us. I suppose things that you want to look out for when applying for working capital loans is rates are displayed in lots and lots of different ways in the market now. So it could be anything from your traditional APR, interest rates can get displayed monthly, annually, and there's lots of different types of interest rate as well. So people are sort of bringing in things like factor rate, flat rate, and they're all quite confusing to look at as an SME borrower. You might not be able to sort of easily compare offers between lenders. So it's worth just keeping an eye on that. If you're seeing different interest rates displayed differently, I mean, it's better to look at the overall offer in terms of how much you are paying in interest and what your monthly payment will be, rather than taking that rate figure at face value. Also on our website, you'll be able to find a tool that will compare offer to offer, regardless of the rate that that it's being displayed as. So you'll be able to fairly assess different lenders against each other in that sense. And fees is another sort of stumbling block that we find with SMEs in particular. It's knowing what fees you're paying before taking the loan. So some lenders might have a monthly servicing fee, they might have early repayment fees, they might have fees that you pay essentially before entering into the loan. So, I mean, it's always worth asking about these. Fleximize makes a conscious effort to be very transparent with these. We have 0 fees on our loans, and we even offer a penalty-free promise to say, even if you paid your loan back early, you'll never pay more interest than what's accrued on your loan to date. So you'll never be responsible for the entire total repayable of your loan. If you repaid your loan early, it'd only be what you've essentially, or how long you've borrowed for is how long you would pay interest for ultimately. But there are a lot of lenders that will say, regardless of when you repay, that total amount that you were due to repay should your loan have gone to its full term will be due. So just a sort of few things to consider if you are looking into a working capital loan. Sorry, I think I'm going to hand over to Andrew now, I believe, to talk about the legal aspects of debt and equity funding.
Great, thanks, Stacey. That was that was amazingly comprehensive summary of a lot of lending in a short time period. So, yeah, as Clive said, I've been going about 20 years as a solicitor. The first third doing banking and finance in the city, mainly structured property finance loans and PFI, film finance, sale and leaseback, and then moved on to general corporate finance, raising money for small and medium-sized companies and general corporate commercial work. So I've got a fairly broad range of experience, and I think today I just wanted to make a couple of points about the legal side of borrowing and lending before moving on to equity and fundraising using shares, which is where an area that the LawBite is particularly active in. But just a couple of points about debt and borrowing. One thing that the first point to make is that often loan agreements are presented to you as the borrower as non-negotiable, and banks and institutional lenders tend not to like to negotiate their standard documents, and that's pretty much the case across the board. However, it's still very important to understand exactly what's in them, and to look out for a couple of key things. The main point to look out for is whether or not the funding is committed for the term of the loan. We see, since the crash in 2008-9, there's been an awful lot of new lenders and lending vehicles pop up, and a lot of short-term lending. And it's important to know that when you borrow 100,000 for 3 years, that the lender is not going to be able to call in that loan early. And we've seen an awful lot of lending which is presented as committed term lending, but when you actually open and read the documents, it says the lender may demand repayment of the loan at any time on demand, and that makes it on-demand lending, even though on the front it says it's a committed loan. So you do need to check these things and look through the loan agreement for any examples of ongoing obligations on you. For instance, to satisfy financial covenants, to provide information, to achieve certain targets. Often lenders will build in an annual review of the loan, which would actually entitle them to call the loan in early. And of course, if you're in breach of any of the ongoing financial obligations or reporting obligations, again, failure will give the lender the legal right to call the loan in early. So it's important to be aware of those things. The second point I wanted to highlight was around the issue of personal guarantees. Almost certainly, for companies without a track record or an asset base, the lender will be looking for personal guarantees. And two things to look out for on personal guarantees. Firstly, that it's well within your right to ask the lender to cap the personal guarantee. That is negotiable. The personal guarantee may well be for all monies owing to the ender, but you may be able to negotiate a cap at a fixed amount. And when there are multiple guarantors, say there are 2 or 3 founder directors that are being asked to give the guarantee, you can also try to negotiate several liability rather than joint liability. And that means several liability means that, say, the 3 directors will each be liable for £33,000 of a £100,000 debt, rather than being jointly liable, where all 3 are liable for the full 100,000, which entitles the lender to go after the founder with the deepest pockets and leave him or her to recover from the other 2 founders. So look out for, see if you can put in a cap, and look out for joint and several liability on personal guarantees. Lenders will generally be looking to take a debenture over the company, and a debenture is simply an all assets security, which charges all the assets of the company, and it will sit there registered at Companies House, and no one will pay any attention to it unless there's a default and the lender wants to enforce the security against the company, at which point a lender can appoint a receiver and take control of the company. So again, it brings us back to the importance of being familiar with your loan agreement and knowing what circumstances entitle the lender to call the loan in early, and at that point enforce its security over the company. I won't go into security any further. It's a big area. And just one other point on debt I'd like to make is the availability of soft money in the form of grants. There are literally hundreds of grants available out there across various sectors and industries. They're often provided by government, national or regional agencies, local authorities, Prince's Trust. There are awards and prizes for entrepreneurs. It takes a lot of research and time and effort to look into grants, but often it's overlooked and it's free or easy money. But the difficulty is that the criteria are often very specific. For instance, there are a lot of grants available for businesses that are involved in science or technology, and you need, and it will be specific areas of science or technology. So it's just a reminder to look into grants in early stage funding. But what I want to talk about mainly today was equity funding for small businesses. The fact of the matter is that quite often debt is unavailable to pre-revenue startups. A business with a great idea, perhaps it's done a lot of work, but at the point that it's pre-revenue, the company is very likely to have limited assets, short or no trading history at all, and very little income to service debt. So quite often the business will look for investment in the form of equity, i.e. money for shares. And there are numerous sources of equity funding. First of all, it's the founder's own pockets. Founders will generally fund with themselves with some startup cash, and investors like to see that. Next point of call will be connections, family and friends, and often that will be put in on a fairly informal basis. And we always recommend entering into a shareholder agreement, even with family and friends at an early stage, so you've got clarity about the number of shares that they're receiving. But on the early stage funding, I'd just like to remind people that you should be looking at a wide range of funding sources. Your ex-employer is a good source. Advisors along the way often have an interest in investing. Competitors, funnily enough, will often be interested in investing in competition which shows promise, so that they can spread their involvement and risk in the sector. Suppliers and clients are also potential investors. However, the main source of equity funding, which everyone's familiar with because of Dragon's Den, etc., is through angel investors and investing syndicates and networks. Generally, professional investors of this sort will appreciate riskier ventures. They will provide mentoring and passion to support the business. They will have sector expertise often enough, and the ability to provide introductions. Just one word of warning about going out to the public in search of funds. Quite often we get approached by businesses saying, look, we just want to issue a prospectus generally to the public and see if people want to invest. The FCA has a financial promotions regime which protects consumers from public offers to invest in private companies. So you need to be careful and there are certainly ways around it if you're approaching high net worth and sophisticated investors. But that's something to be wary of. I'd like to just mention, if we can move on to some other helpful institutions, incubators, accelerators, and venture builders. Incubators tend to be early stage and help the business get up to pitch standard. And they're actually involved early on in helping businesses and entrepreneurs to work out their ideas, their strategy, and their structure. Accelerators tend to take over from that stage, although there's a lot of overlap, and expedite the growth of the startup. Often the aim is to get a minimal viable product. There are tighter timelines. Often accelerators will provide some seed funding or pair you up with mentors as well. Venture builders are similar to accelerators, but perhaps a bit more hands-on. There's a lot of overlap in this sector, with all of them generally providing combinations of the same mentoring and introduction services. Universities, of course, are getting very capable at providing a lot of these services: seed funding, mentoring, including incubator spaces, office space, and all the introductions. Again, I won't go deeply into all this. I just making a note of that for those that are unaware, which I'm sure you all are. Just before, next slide, please, Angie. Just before going into equity funding, there is this area which is in between debt funding and equity funding, which generally is called quasi equity, but will involve investors investing money by way of debt, which is later convertible into shares in the company. There are specialist venture debt providers, and they will typically provide a secured loan. So they'll often look to take a personal guarantee or security over the company, with an equity kicker, which allows them to get their loan back and also receive some equity in the business, usually at a fixed price. The main vehicle for quasi equity is convertible loan notes. Basically, the investor will lend money to the company in exchange for loan notes, which are convertible at a later point into shares in the company, usually at a discount to the value of the company at the point that the conversion takes place. So a common discount is 20% to the future valuation of the company, and the loan note holder, i.e. the investor, will usually be allowed to convert their debt into equity just before any of a series of conversion events. Chiefly, if you go to sell the company, they can convert into shares. But if you are lucky enough to list your company on the stock market, that would be another event. But the main event which investors look to convert their debt into equity is when there is a new equity fundraising, and at that point the loan note holder will convert at a discount and benefit from the new equity fundraising, and usually continue investing. Convertible loan notes are generally not secured, but it is possible for the loan notes to be secured if the company has any assets. You might also mention hear advanced subscription agreements mentioned. Essentially, they're very similar to convertible loan notes, and it's basically a commitment from an investor to invest equity at a later stage, but very, very similar to CLNs. So moving on to the next slide, I just want to give a quick overview of the two main stages of equity funding once we get past family and friends. Pre-seed and seed funding, there's a lot of discussion about what size funding is pre-seed and what kind of size funding is seed investment. I think generally anything up to $1 million is considered to be seed funding. And the main thing that we see doing a lot of early stage startup funding is that the structuring of the deal involves bringing in money from a lot of different sources. You've got your main angel investor or venture capitalist putting in money, but you could also have sources of funding from all the family, friends, incubators, crowds, etc., etc. The main point of the first official equity funding stage is to professionalize everything and get proper documentation in place. The founders will be expected to give quite a few commitments in the investment agreement. They're often asked to give warranties regarding the state of the business, and sometimes they're asked to personally stand behind their promises to achieve certain KPIs in the first period of the company. The founders will be expected to commit to the company, and perhaps as employees, or devoting a significant amount of their time and energy, or intellectual property, or introductions, whatever they're bringing to the party. The initial investment shareholders agreement is the place to bring all of that together. The next stage, once the company has grown successfully, and you start to see, valuations in the 2 to 5 million bracket, is you will begin to see larger and more sophisticated investment in a series funding, A, B, C, as the funding grows. But at that stage, you're seeing companies with quite a developed track record, and they have some assets, they have revenue, and there's a real growth plan in place, which is going to allow the company to scale up and achieve the higher valuations that are expected. A few things. Obviously, it's a big area to cover in a short time, but I just want to touch on, in the next slide, a couple of key things that are going to arise in both the seed funding and series funding agreements. Often we'll see investors wanting to receive preferred shares, and the most common preference that investors will look to secure for themselves is a liquidation preference. So if the company fails, the liquidators will get their money. If there is any money in the company when the company fails, they will have a preference over the money that is available for distribution to the shareholders. There are a range of other preferences that they may look for, and this is fairly common, so it's something to be expected. but it certainly everything is up for negotiation. Generally speaking, the preferred shares will be convertible into ordinary shares of the company, the same as founders and other shareholders hold, just before a major fundraising, listing or sale of the company, so that they don't necessarily receive a preference in terms of the value of their investment, because just before the value is realized, they will convert to ordinary shares. But again, there's a lot of variation in this area and a lot of negotiation that can go on. Generally speaking, investors will not be allowed to have redeemable shares or a fixed dividend. For a number of reasons, companies will resist it, founders will resist it, and it can jeopardize tax relief, and it also harms the accounting of the company if the shares are redeemable, because it's classed as a debt of the company. So beware of investors that want to invest with redeemable shares or fixed dividends. Anti-dilution is a term that will come up quite often. Founders will sometimes start off saying, we want anti-dilution protection, or an early investor will say, I want anti-dilution protection, so that when a future investment in the company occurs, they will be issued more shares to stop them from being diluted by the new investment. Now, it's a good idea. It makes sense to see why founders or investors would want this, but often they're cutting off their nose to spite their face, because it's a big disincentive to future investors investing in the company. And a future investor will come in and say, look, I'm prepared to put in a lot more money than you put in early stage. If you want to invest at the same price that I'm investing at, then please do so. But I'm not going to invest if you're just going to get shares for free to stop you being diluted. So quite often, anti-dilution is an idea which is dismissed, and what everyone settles on is a preemption right, which says that when the company goes out to market to raise new investment, then existing investors will have the right to invest at the same price as the new investor. And this is a fairly standard approach, and it makes a lot of sense, because when the new investor invests fresh money in the company, if the existing investors choose not to invest at that price, sure, they will get diluted. They've had the chance to invest, but if they choose not to, they're diluted, but they have a smaller share of a bigger pie. So there is a fundamental fairness to the way preemption rights work. And the last thing I'd just like to touch on, because I think I'm just out of time, is valuations. There's an awful lot of talk about valuations as though it's a science, that every company has a real and specific valuation. Generally speaking, in small startups and even bigger ones, valuations are a commercial negotiation between the investors and the company, with the involvement of accountants. Accountants will have got very scientific valuation techniques, like the most important being profit to earnings ratios, and a company will be valued on the basis of a multiple of the profits or earnings that it makes. But in early startup companies where you don't have a lot of revenue, there's no earnings to base that on, and these accounting techniques aren't really applicable. But the valuation is negotiated, and it's usually based on a calculation, an assessment of what the potential upside is for this company and the likelihood that it's going to achieve it. So the share price for equity investing is calculated by dividing the pre-money valuation by the number of shares, but the valuation itself is often more of an art than a science. I'll probably just leave it right there, as I think I'll run out of time. Is that a good time to finish up now, Stacey? Oh, I forgot to mention there is a special discount at the moment running with LawBite, a 10% discount on legal orders. And I should just mention as an aside, part of the deal at LawBite is for all clients a 15-minute free consultation. It works really well. We get to cover a lot of ground in a short period of time, and if we can provide some help for free, then fantastic. You may not need any legal help. If you do need legal help, we can give you a really good idea of what's required, how much it's going to cost, and how to go about it. So do try it out. I find it works really well, and clients are generally very happy with it.
Thanks, Andrew. That was great. I think really useful. I think there's a next slide for Stacey as well. That's right. Yeah.
So hello again. Just going to talk a little bit about how Fleximize can help if you are looking for debt funding. So essentially, we offer two products: one for sort of newer businesses, minimum of 6 months trading for us, and one for businesses that have been trading a little bit longer. Essentially, they very similar to borrowing anywhere between £5,000 and £500,000 for anywhere up to a term of 48 months for businesses that have been trading a little bit longer, 12 months for those who haven't got so much trading history. Rates start from 0.9% a month. Obviously, there's no penalties for repaying early with the Fleximize loans. We also put 2 repayment holidays in our agreements as standard in case you do need a sort of little break from repayments, which obviously over COVID has been really useful, and you can get the funding within as little as 24 hours. And we've got a special offer for those of you who have attended the webinar as well. So there's a coffee on us for anyone who does sign up to our member marketplace. You'll find a lot of discounts and offers for sort of B2B services that SMEs would tend to find useful, and a subscription to our Knowledge Hub as well for additional business support.
Very good. Thank you both very much indeed. I think that's very practical and I hope useful for people. We've got a few minutes left for questions. If anyone wants to contribute there. I can't see any just this minute. One question I had for you, Andrew, on equity was maybe just to talk a little bit about the sort of diligence that's required when you get equity funding, because often that's a bit of a surprise to SMEs. There's some of the things they're meant to produce and sort of be accountable for, and you know, there's a lot to be said for being prepared for all that before you start.
Yeah, I mean, you have a wide spectrum of investors. From at one end of the spectrum, investors that say, I love you as a person, here's my money, get on with it and make me some money. And they don't do any due diligence, and they just really, they trust the person that they're investing. And at the other end, you've got investors that will carry an enormous amount of due diligence, and they will also expect the founders to give warranties and stand behind the promises that they've made in the pitch to the investors, and there's a lot of in between those two extremes, but ordinarily, you know, founders, need to expect a reasonable amount of due diligence into their business. And the big area that we see where problems arise is around intellectual property, because founders as people, they create the app, create the idea, but they don't actually transfer the intellectual property into the company. And the investor is investing in the company. So the investor wants to be sure that all the IP is actually transferred to the company. Often people assume the IP rests in the company, but if I write something and have copyright, or if I create a software program, I own it. I physically have to transfer it into the company. So that's a classic bit of DD, which is important to investors, and which needs to be done before you do the investment.
Very good. I can see one question's come in from Bianca. When looking for investment of 5 million and upwards, what are the key points you should be looking for / route to potential investors? So I think you probably touched on some of that, Andrew, but maybe just a quick summary.
The main routes. Look, aside from family, friends, ex-employers, and people that you trade and do business with, I think the last 10 years has been the emergence of incubators and accelerators and angel support networks. I mean, it's such a sophisticated market now, and the level of capital that's available is nothing like the US, but the professionalization of the industry in the UK has just occurred in leaps and bounds. So there are literally dozens and dozens of places that you can go. LawBite partners with a lot of professional investment support networks and things, and there are so many out there. It's difficult to summarize, but I would certainly be making use of them. And as my particular favorite is university support networks. There's a lot of money behind there. Businesses are really interested in dealing with universities, and that's a great place to start if your business has a connection to a university. And often it just requires a phone call to the university, and they're very willing to support.
Yeah, I mean, I think probably 5 million upwards, you're looking at in some sort of institution, an institutional lender or an investor of some kind, small VC or a family office probably. Yeah. And there you're into this kind of balances that Andrew was talking about in terms of balance between accessing the money and the valuation you can get, and the sort of controls they have over the shares and the company generally in return for giving you a significant amount of money to spend. Yeah. Stacey, just on debt funding. So are we now at a stage where the government COVID initiatives are now at an end? So there are no more out there. Is that right, or is there still anything left?
There's still recovery loan scheme ongoing at the minute, very similar to the CBILS scheme. And I think the general feeling in the market is that people that sort of took CBILS loans are not generally getting huge success in applying for RLS. So yeah, that's still going on in the background, but I think we've seen, especially over the last couple of months, a lot of commercial lenders sort of coming back in with a little bit more confidence than perhaps they had over the last 18 months or so. Yes,
I'm sure that's right. And in relation to debt funding, is the working capital one, is that the most common route that you find yourself going down?
I mean, obviously, I suppose the businesses that we see, then absolutely yes, working capital. And we do a few sort of transactions which might be, I suppose, stopgaps between us and other types of funding, particularly with asset and property, which can take a lot longer to sort of come to fruition, people will often use working capital as a stopgap between now and sort of here and then as well.
Yeah, very good. All right, we just got a couple of minutes left, so just want to invite any last minute questions before we let Andrew and Stacey go.
I had a question from Paul. Have I written a book? And I can no, probably never.
I've written a book, not that you asked me, on law for small business for dummies, part of the dummies series. So there's a section on investment and funding and debt lending in that book, and it's certainly meant to be written, you know, in a style that's just as accessible, hopefully, as the talk we all had with you today. So maybe that's worth checking out. Good. Any more? Otherwise, I'll give you 2 minutes back of your life, and you can get on with your next meetings. No? Okay. Well, I think that just remains for me to say thank you to Andrew. Thank you very much indeed for your time and insight, and thank you to Stacey for being our guest today. And that was a really, really helpful insight into debt funding. Andrew, is there anything else we need to do? Otherwise, we'll send everybody on their way and wish them a really good afternoon.
That's all from me. Have a fantastic day. Good luck with everything.
All right.
Thanks
Cheers.
for having me.
Thanks a lot.
Thank
Pleasure.
you.
Bye-bye.